Yeah, look, Japanese holiday today, followed by obviously UK bank holiday and then the Queen's funeral, etc. So Europe's going to be pretty quiet as well. So we won't really sort of get to see any major movements probably until the US session opens tonight. But yeah, look, there's a few stocks that sort of moved around. One in particular that was there, Polynovo, had a really good announcement today. It's sort of one we've had our eye on quite a bit. So they got an FDA approval today for a product that's going to have $500 million addressable market. So they were up around the $2.25 mark at one stage. There was a big stream of director buying there, about $6 or $7 million worth, and I think it's a bit of an unwind of it was one of the most shorted stocks on the ASX at one stage. So it fell away after reporting season, but just mainly on the back of very sort of growth orientated annual report. But look, I don't think anyone's in this stock looking for dividends and low PEs, so it was probably a little bit of an overreaction to the downside there, and I think this positive announcement sort of turns it around and expands its market. So be one to watch out for the next few days. It did get up to about 164 this morning and sort of just drifted off on low volume until in the afternoon session.
Yeah, okay. So just a typical momentum play there, doing what momentum plays do.
Yeah, and look, these FDA approvals do have a nasty habit, particularly on thin volume of being very well bid on the open and then drifting off back to where they opened over the course of the day. So it was probably not a bad one for the day traders there, I suppose, today.
Yeah. Well, probably one of the few wins that you could really find. But just in terms of what we're going to do today, go across the favourite staple, favourite financial, and favourite health. Staples we'll kick off with.
Yeah.
Elders. What's appealing about Elders?
Look, when they reported back sort of in, would have been May, stock traded around about $15. The outlook was very rosy. Management's really executed over the last sort of 8 years. They had an 8-year plan which they've more than executed on. Their gross margin grew in every single sector. They've got about 8 or 9 different revenue funnels now. So it's a company that's while the country's doing well, it does very well. It's got insurance, fertilizers, livestock sales. It's in real estate. So as Koshi quite often describes it as an agricultural ETF, but it's far less cyclical than it used to be. And I think they've only had one pullback in sort of NPAT over the last I think around about the last 7 years, and it was very minimal. And in that time, we've had a couple of droughts. So and they're multi-state as well. So whilst there might be floods or bushfires, they're not everywhere. They're fairly isolated incidents. So and look, with that El Nino being pinned to the east coast at the moment due to the weather pattern in the Indian Ocean, water tables are quite full. I think there's some more flooding going on out in Western New South Wales. So, but most of them have managed to get their crops off fairly well. So they've had a decent winter season on top. So yeah, we really only see upside for these guys, and particularly in a market which is largely nervous, as you said before. Consumer staples is a sector that's done particularly well. So I think it's sort of drifted off with a lack of news and obviously foot and mouth concerns. But I would generally say our quarantine is one of the best in the world here. So we may have a situation where if foot and mouth becomes a problem globally, like mad cow disease, if we close our borders, it actually ends up being a positive for us. So, I think they're about 8 weeks away from reporting. So I think the closer we get to that date, I think the better supported the stock will be overall.
Okay, so that's Elders. The financial that you like, though, is Macquarie. This is an interesting one because, I dare say, maybe underperforms, say, just compared to some of the other blue chips a little bit. Is it just starting to look good on a valuation basis? What do you like?
Absolutely, yeah. Look, it's average. You look at it from a PE perspective. It's in the lower third of the range generally. Yields getting up there as well. Macquarie's not one to generally disappoint. They do quite well in volatile markets. We have had a pullback, in those US style banks overall, but Macquarie's the number one ranked return on equity in the MSCI globally for about the last decade, I think. So, whenever you get opportunities to buy a high quality company with such a consistent return on equity, then it's and again they're coming into reporting probably in the next 5 or 6 weeks because they're in out of cycle. So you would expect them, getting closer towards the date that there'll be more clues as to what's going on there. And but they're already really consensus price targets around the $200 mark. I think they improved profits by $500 million or something last report, and then fell away from that point. And then the broader market movement sort of compounded that, and I think there's a sort of, without a lack of catalyst, they've just sort of drifted a little bit lower. So they're definitely one, which I really like to buy on dips, because they're such a steady performer.
Okay, and you can see the chart on your screen there too, looking, in the long run, very, very positive. But last stock that we're going to look at here, we're going to dig into Polynovo again, aren't we? So that's basically the story we're talking about.
Yeah, the story there. Look, and from your more sort of traditional, I think Sonic Healthcare's, at a very low PE and a very good yield, and Ramsay as well with the fall through of that takeover bid from KKR, both looking relatively cheap. So if you're looking to add some non-cyclicals, given we've had market nervousness, and obviously we're talking 75 basis points in the States, and a whole raft of Asian countries and Europeans having central bank meetings this week. Well, those non-cyclicals, particularly if the pace is going to pick up for interest rate hikes in the States and push the economy into recession, those non-cyclicals are going to be a very key part of trying to maintain your dividend yields and the performance of your portfolios. So yeah, from that more traditional, bigger companies that's not in that growthy, and Sonic would probably be, Sonic and Ramsay would probably be the two picks there as well. So
right, just one final question before I let you get back to the end of your day and the start of your week, I suppose you can say. But we've always had really good discussions just around how you approach things with these big risk events coming, like we are in the next 3 or 4 days. How are you approaching it? Because it's a little bit of dead air until about the middle of the week, and then everything sort of hits us. Are you just sort of standing back? What's your approach?
We're being really patient. We've had a Nasdaq short on for probably close to a month. We've basically cycled out of that almost completely now, and depending on the level of cash in portfolios, and we've got basically anywhere from 20 to 30% cash sitting there. Broadly across portfolios for clients, or that's the general recommendation. And then over I think September, October tend to be volatile periods from a seasonal standpoint. So we're just generally looking at, we've got a shopping list we've made up overall, and we're with targets for entry. And we'll just sort of sit there and try and dollar average or stick to our plan in terms of what we want to add to the portfolio over the next sort of month or so. So we're whether they get down to the entry points that we need, well, we won't sort of succumb to fear of missing out. We'll sort of take the opportunities as they come. But I think patience, particularly for the next sort of for the next 6 weeks at least, until we get through one more inflation number, and this obviously their central banks, sitting on the sidelines isn't the worst thing in the world. Or for instance, with our uranium exposure, we're utilising that new ETF from beta shares instead of being in the single stock names that are mainly non-producers in Australia. So just trying to de-risk a little bit and have some cash on the sidelines for any opportunities that arise.